Federal Reserve is often misunderstood. It's not a government agency in the way most people think, and it does not directly set mortgage rates. The Federal Reserve was created in 1913 after a series of banking panics repeatedly shut down the economy. At the time, banks were overlending, people rushed to withdraw their money, and there was no system in place to stop total collapse. The solution was to create a lender of last resort, an institution that could inject liquidity into the banking system during emergencies. That system reduced bank runs, but it also introduced a new problem. When financial institutions know they will be rescued during crisis, they are incentivized to take more risk. A major turning point came in 1971, when the United States left the gold standard. From that moment on, money was no longer tied to a physical asset. It became debt-based. This allowed the money supply to expand far beyond economic growth. When new money enters the system, it does not raise wages evenly. It flows first into assets, stocks, bonds, and real estate. That is why housing prices rose dramatically while incomes failed to keep the pace. Over time, housing stopped being treated primarily as shelter and became an investment vehicle. Today, the Federal Reserve is constrained by the system it helped create. Raising rates risks breaking debt-heavy markets. Lowering rates risks fueling inflation. That is why housing affordability cannot be fixed by interest rates alone. This is not a conspiracy. It is the result of incentives built into the system. I'm Money Mike, keeping you informed.